Hey, what's up, my friend? So in today's video, you will learn a mean reversion trading system that has generated 2,834% over the last 25 years. So to put things into perspective, that's about a 14% annual return with a maximum drawdown of 27%. And by the way, the S&P 500, if you buy and hold it for the last 25 years, you're looking at about 8 to 10% returns a year with a maximum drawdown of 55 or even 60%. So you can see that this system has a higher return and lower risk compared to a buy and hold approach on the S&P 500. And the best part is that this trading system has close to a 70% winning rate. So it's going to be easier on your trading psychology because out of 100 trades that you put on, about 70, close to 70 is going to be a winner. So if you're interested, then today's training is for you because I'll explain to you what is mean reversion trading, the exact trading rules of this system, the entry, the exit, the risk management, and much more. Sounds good? Then let's get to it. So what is mean reversion trading? So I want to make sure that we are all on the same page over here. So mean reversion trading is when stock price deviate from their average price. Because when they do, they usually revert back to the mean. I'll show you shortly, right, what this looks like on the chart. And as a mean reversion trader, you look to profit from this snapback. So imagine this, imagine there's a rubber band, an invisible rubber band in my hands. When I pull that rubber band and I let it go, what happens? The rubber band snaps back. So it's the same thing for stock trading. So as a mean reversion trader, what you're trying to do is this. You're identifying, in fact, let me just move on to the concept first. You're looking to identify stocks that are in an uptrend, something like this. And then you wait for a pullback and you buy on the pullback. You're not waiting for confirmation, reversal pattern or whatsoever. As a mean reversion trader, mean reversion stock trader, you are trying to catch the falling knife. Okay, you buy on a pullback, buy when the market looks bearish. And when the market makes a bounce, okay, you sell, thereby capturing this bounce, this quick profit over here. So this is the goal of a mean reversion trader, someone trading in the stock market. And of course, these concepts that I've shared with you, the idea, it is not enough, right, to develop into a trading system because a trading system must have a fixed set of rules. When exactly do you buy? When do you sell? How much to buy and sell and stuff like that. And this is where we move on into the trading system itself. So earlier, the mean reversion, the concept is more of a high-level strategy. So now we're moving into the system with exact trading rules. So we're going to be trading stocks in the Russell 1000 index, pretty much the largest 1000 stocks in US. So you can easily enter your trades and exit them with minimal slippages. Time frame is a daily time frame. And risk management, 20% of your capital for each stock and a maximum of 5 positions. I want to explain this one a little bit because I think many traders watching this might be thinking, man, Rayner, what does it mean? Let me explain. So imagine you have $10,000 trading capital. What this means is that you can hold a maximum of 5 stocks. And each stock you will buy $2,000 worth of stock. So 2,000, 2,000, 2,000, 2,000, 2,000. Okay, and if you buy 5 stocks, you will realize that all your capital will be used up. So there's no leverage involved. So let's say, for example, let's call it stock A. There's a valid trading setup and you want to buy. How much stock A do you want to buy? Well, you buy $2,000 worth of stock A because that's the maximum amount of dollar value you can assign to one stock. Make sense? Now, let's have a look at the trading rules of this system. So number one, the stock is above the 200-day moving average. So this is the criteria to define an uptrend. It's kind of like, you want to make love to your wife. You want to pop the question, you want to hint to her when she's in a good mood. Same for stock trading. When you want to buy stocks, especially if you want to make money on the long side, you want to make sure that the overall market, the overall stock is in an uptrend. So the way we do it is that the stock must be above the 200-day moving average. Next one, second rule. And by the way, some of you like to ask me, Rayner, should I use the simple moving average, the weighted, the exponential? My answer is this. It doesn't matter. It doesn't matter whether you're going with the SMA, the EMA, the WMA, the MMA, whatever. Because the concept is what matters. If you think about this, the difference between a 200 SMA, EMA, whatever MA, the value is going to be very minimal. Okay, maybe one could be, let's say, a value of 200 for the SMA. Then the EMA, the value could be 200.5 or 201. it doesn't really gonna change much. So really the concept is what matters. And I would be worried, or you should be worried, if someone tells you that it makes a big difference. Because if it does makes a big difference, clearly the trading rules are over-optimized and the strategy, the system will likely not work in the real world of trading. So whether you go with 200-day simple moving average or whatsoever, it is not important. What's important is the concept behind it, which is pretty much wanting to define stocks that are in an uptrend. There are many ways to go about it, and in this case, I just simply use the 200-day simple moving average. Next one, the stock closes below the lower Bollinger Band. So this is the way to define the pullback. And again, it's not the only way. You can use RSI, stochastic, or whatsoever. But in this example for this system, I use the Bollinger Band. When that happens, you then place a 3% buy limit order for the stock. So this is to help us define stocks that are oversold. And the 3% buy limit order is based on the previous day closing price. Okay, just to be clear over here. So number 4, if your order is filled, you sell when the 2-day RSI crosses above 50 or after 10 trading days. So this is the criteria to exit your trade. So most of the time, you will exit when the 2-day RSI crosses above 50. I would say 80 to 90% of the time, you will exit through this mechanism. But there are times, right, when you capture a falling knife and the stock price just goes down day after day like diarrhea, and it doesn't even make a bounce. So this is where we want to have a time-based stop loss to cut our loss after 10 trading days, a maximum of 10 trading days. And this criteria will be used if this doesn't happen. So there are times, right, where stock price just diarrhea. You still have to hold that stock for 10 trading days and then sell it, right, if the 2-day RSI has not crossed above 50 within that 10 days. And finally, if there are too many stocks to choose from, select the ones that have increased the most in price over the last 150 days. So because you're trading stocks in the Russell 1000, there's 1,000 stocks that you can trade. So sometimes there are many opportunities lined up for you. What happens is that you'll be spoiled for choice, like a buffet. Oh, which one do I pick? So this is where the ranking system comes into play. You want to select stocks that has increased the most in price over the last 150 days, because these are stocks that are the strongest. That's why they went up the most in price over the last 150 days. And these are the stocks that are likely to continue higher. So that's our ranking system. And finally, the Bollinger Band, we tweak the settings a little bit. We use 2.5 standard deviation instead of the regular 2 standard deviation for most charting platforms. When you insert Bollinger Band, it's usually 20-day moving average and 2 standard deviation. For this one, we go with 2.5 standard deviation. So in this case, right, we are looking for the stock to be, or rather to define it to be more oversold in that aspect. Now, let's have a look at an example so you can see how this trading rules look like, and also how to add the indicators and adjust it on your TradingView platform. So I'm using the replay mode. Let me just see. Okay, looks better now. So first thing first, we need to make sure that the stock price is above the 200-day moving average. So you look for SMA, just click on this. I'm just gonna change this to 200 style. I like it black, because that's how I define my 200-day moving average. So you can see the stock price is above the 200-day moving average. Our first criteria is met. In fact, if you need a refresher because you have a memory of a goldfish like me, number 1, the stock price is above the 200-day moving average. Number 2, the stock closes below the lower Bollinger Band. So next thing we need is the Bollinger Band. So look for Bollinger Band. And if you recall, the Bollinger Bands that we use, we tweak the settings slightly. We go with 2.5 standard deviation. So you can see over here, original settings was 2, so I'm changing it to 2.5. Okay, and then you would remember that it has to be close below the lower Bollinger Band. So over here, you can see over here the stock price did close below the lower Bollinger Band. So what we need to do now is to place a 3% buy limit order to see if we get filled on the trade. So what we need to do is to find out what is the closing price on this for this candle here, and then just multiply it by 0.97. So I went to get my calculator. So you can see the closing price is 27.71. You're going to multiply by 0.97 and you get 27.71 multiplied by 0.97, 26.87. Okay, and what I'm going to do is just going to illustrate on the chart where is 26.87. I'll use this green line over here. Boom. Oh, it's red. Let me just change this to green to signal our entry. And the coordinates is 26.87. Okay. So what's going to happen is that if the next day, the stock price falls to this green line, we would have gotten filled on the trade because we are placing a buy limit order with your brokerage account. So you can see over here, boom. Next day, the market gap down lower and obviously we're going to get filled. Depending on what price, you might get filled at a lower price compared to the limit order that you've gotten filled as well. So anyway, you will be filled on this trade. So now, next thing to remember is what's the exit? Exit is when the 2-day RSI crosses above 50 or after 10 trading days. So the next indicator that you will need is clearly the RSI indicator. Relative Strength Index. I'm just going to change the settings so you can see how I do it. The length is 2 period. We don't need the moving average one, so just going to remove this and click OK. So at this point, you can see that the RSI value, it's actually 0.95. We are looking for it to be above 50. So let's see if it goes up higher or not. Still below, right? Right now it's 15, 13, boom, 71, you can see. So now the 2-day RSI is above 50. This is where we're going to exit this position, possibly for a loss. So now, as you can imagine this, right? The RSI value is only confirmed. This is only confirmed when the market closes. So of course, you can't exit your trades when the markets are closed. Well, you can trade after market hours, but usually you get very poor fills. So what we're going to do is we only exit this trade then at the next day when the market opens. Boom. So it opens over here, right at this price point. In fact, if you want, I can just use this tool over here to change this to red. Okay. And this is our exit. So we can see over here, we bought at this green one and we sell at this red level. And clearly this is going to be a losing trade. But the purpose of this chart is not to show you winners or let you think, oh man, this is the holy grail, you're going to win all the time. No, it's just to kind of like show you how the trading setup works, where we enter, where we sell and whatnot. And of course, one trade doesn't mean a thing because it's just random luck, right, in the short term. So this is why when you have a set of rules, when you have a fixed trading system, you can run a backtest on it and see how this system has performed over the last, in this case, 20 over years. Let's have a look. Okay, so you can see over here, this is the equity curve of this trading system over the last 25 years. Up about 2,834% over the last 25 years. Breaking this down further, you can see the month-on-month, year-on-year results. Like in 2000, January is up 12%. For the year is up 97%. 2024, the system made 29%. We have a few losing years like here. So 4 losing years over the last 25 years. Not too shabby. And for the detailed breakdown, you can see over here 2,834% since 2000. So annual return is about 14% a year. 66% winning rate, 33% losing rate. Payoff ratio, this is important, so let me explain. So how we define payoff ratio is that we take our average profit divided by our average loss. And you will realize that for this system, your payoff ratio is less than 1. So what this means is that on average, your losses are larger than your winners. And you might be thinking, so Rayner, if that's the case, then how is this system still profitable? Well, the reason why this system still makes money in the long run, despite having the average size of their losses being bigger than the winners, is because of this. Your relatively high winning rate. You're winning about 66% of the time. So you can see that you're winning twice as often compared to losing. Right? You lose 33% of the time and you win 66% of the time. And maximum drawdown is 27%. So what does this mean? So let me explain. This is again very important, especially when you are trading strategies, systems or whatsoever. You want to know what's the maximum drawdown of the system that you are potentially trading. So let's say if you have $100,000 trading capital, and let's say over the last 10 years, the worst your capital went down to was, let's say, $50,000. And then eventually it went back up higher to, let's say, $200,000. So from 100,000 down to 50,000, we call this a 50% drawdown. That's the maximum drawdown that you have experienced trading this, let's say, this system, right, over the last X number of years. So from the peak to the trough, we want to measure how deep is that decline in terms of percentages. So the deepest, the maximum decline, we call that the maximum drawdown. And for this system is 27%. And to put things in perspective, if you buy and hold the S&P 500, let's say from 2000 to right now today, I believe your maximum drawdown for the S&P 500 is 55 or 60% thereabout. So this is to kind of like give you an idea of what's the maximum drawdown for a buy and hold investor in the stock markets. And moving on, the pros and cons. Let's talk about the pros and cons of mean reversion trading, because no trading system is perfect. So I just want to let you know what are some of the advantages and disadvantages that you will experience. Number one, you have a relatively high winning rate, right? Mean reversion trading systems, I generally see it, above 60% winning rate. Some even as close as 70% is doable as well. This type of trading strategy usually do well when the stock market is ranging or in a choppy bullish market, because if you imagine this, if the market is bearish, you are not going to get too many stocks to trade, because most of them are going to be below the 200-day moving average in the downtrend, so you won't have too many trading opportunities. At the same time, if the market is very bullish going parabolic, you also won't have too many opportunities, because there isn't a pullback that you can buy into, because remember, this trading systems you buy on the pullback. So if the market is very strong going parabolic, again, this system is likely to underperform. So usually it does well in a choppy or bullish but still choppy bullish market. This system tends to do well. The downside is you get the less than 1-to-1 risk reward ratio, because you've seen earlier the average loss is slightly bigger than your average profit. And finally, you would tend to give back profits in a bear market, or rather I would phrase it, you would tend to not do so well in a bear market. And give back profits in a bear market meaning that sometimes you could buy the stocks and then the market goes into a sudden fear, right? It drops like 10%, 20%, like for example the recent tariffs, right? So a number of your positions, right, are going to get hit when such a sudden decline in the stock market happens. So you will tend to give back profits, or you'll see your account go into a drawdown during this period. And of course, it doesn't go down forever, because if you recall, we have a trend filter for the stocks. The stocks must be above the 200-day moving average. So if the overall stock is in a bear market, going down 20, 30, 40%, by then you're probably in cash already. And for systems like this, you'll remain in cash till things reverse, and then you start going back long to look for opportunities again. Now, before you go, I'd like you to get access to this free training. You can get it at tradingwithrayner.com/go, or in the description or in the comment section below this video. So in this training, you will discover 3 rule-based trading strategies that work, and they're all backed by data. In fact, the strategy that you've just learned is actually taken from this training. So you will learn, in other words, 2 more extra trading strategies. And again, I'll walk you through the trading rules, the entries, the exits, the risk management, and chart examples, so you can quickly understand the concepts of these strategies. And that's not all, because I would also like to give you the PDF slides of this training, the trading strategies cheat sheets, so you can quickly recap the rules of this different trading system, and the backtest report of all these different trading systems, so you can see the winning rate, the losing rate, what is the payoff ratio, etc. All the backtest report given to you in this training for free. So everything is free over here. Just go down to tradingwithrayner.com/go, or I'll put the link somewhere in the description below or in the comment section below. Just click on it, you come to this page, and you can get started immediately. So with that said, I wish you good luck, good trading. I will talk to you soon.